right? And here you have the net increase of foreign assets minus the net increase of foreign liabilities, excluding central bank reserves. And here you have the increase of central bank foreign exchange reserves. Now, what's a bit confusing is that the word reserves shows up in monetary economics in a lot of points, right? Sometimes we call about commercial bank reserves. Sometimes we call about central bank foreign exchange reserves. So never talk about reserves as such, but say we're talking about commercial bank reserves, which are the commercial bank's deposits with the central bank, or we talk about the foreign exchange reserves of the central banks, which is the foreign exchange holdings of the central bank. Now, this is something that emerges from balance of payments accounting, and we did a lot of balance of payments accounting on the first day, right? This holds. It also emerges from the double entry bookkeeping principle. But let me interpret that as a foreign exchange market equilibrium condition. So the current account balance is positive if the sum of net exports plus of goods and services plus net primary income plus net secondary income is positive, and it's negative if the sum is negative. Now, the current account potentially depends on the nominal exchange rate, E, and other determinants. We call those current account shifters. So the current account is a function of the nominal exchange rate and other stuff. And we conjecture that this partial derivative is positive. Now, why? Well, because think about what we did just an hour ago. Nominal exchange rate going up means terms of trade are worsening, imports becoming more expensive relative to exports, and that in turn, with sticky prices, term implies that net exports go up. So if the domestic currency becomes cheaper, your current account goes up. You're selling more stuff and you're buying less stuff abroad. Okay, so this is something plausible. We assume that the capital account balance equals 0 because it's a pain in the neck anyway. Now the financial account balance is positive. Now let me come to that part of the balance of payments equilibrium. If the net acquisition of foreign assets is greater than the net incurrence of foreign liabilities, that if the country exports capital. Now please note, if the financial account is positive, you buy foreign assets, actually buy more foreign assets than you have foreigners buy domestic assets. So your assets increase more than your foreign liabilities. And if it's negative, then your liabilities increase more, then you have capital inflows. That's important that you get this straight, right? FA greater than 0, capital outflows. You have a demand for foreign assets, which is bigger than foreigners' demand for your assets. Financial account negative means capital inflows, so you have a lot of demand, foreign demand for domestic assets. So the net acquisition of assets and the occurrence of liabilities reflects the decisions of agents, institutions outside the central bank and of the central bank. So if the central bank purchases foreign currency denominated assets, its stock of foreign exchange reserves increases. So what the central bank essentially does by intervening in the foreign exchange market, it buys foreign assets. That's what the Swiss National Bank did in the 2010s. They bought euro area government bonds, big time, in euros, right? That's how they intervened. And of course, indirectly, they needed the euros to get those euro, to be able to buy those euro govies, as they call it. Good. So FANR, so outside the central bank, potentially depends on the nominal exchange rate, E, and other determinants, which we call financial account shifters. So we conjecture that this partial derivative is negative. Why should that be? Well, here's an argument that's a little bit shaky, but it's not completely implausible. ceteris paribus, that is for given values of other variables, including expectations about the future exchange rate, a higher value of E raises the return on domestic assets relative to the return on foreign assets. So if E goes up, it's cheap for foreigners to buy domestic currency. Now, if it's cheap for foreigners to buy domestic currency, it's also cheap to buy domestic assets. Now, if foreigners find it cheap to buy domestic assets, they buy lots of them. Now, if foreigners buy lots of domestic assets, liabilities increase by more than assets, and the financial account goes down. Right? So that's the logic. So it's like, you know, you want to buy a German government bond. The euro depreciates. No. You want to sell a US government bond. The euro depreciates. All of a sudden, you have all these Americans who say, wow, that's a bargain, right? The interest rate is fixed. Suppose we abstract from exchange rate expectations. We just buy that stuff because it's cheap. There's much more to be said on that, but let's just take this simple partial derivative. Balance of payments equilibrium has to hold by definition, but it can also be interpreted as a forex market equilibrium condition. And the key idea is that every balance of payments transaction is associated directly or indirectly with a forex market transaction. So agents have to use domestic or foreign currency to pay for domestic or foreign goods, services, and assets. So a flexible exchange rate adjusts to equalize currency net demand and supply resulting from these transactions. So if you have the current account balance depending on the nominal exchange rate, and you have the financial account balance depending on the nominal exchange rate, then you have, and the capital account, which is, you know, a pain in the neck, which we ignore. Then if the current account balance is positive, then there's huge demand for foreign goods relative to foreign demand for domestic goods. Now, all those domestic residents, they want to buy, all those foreign residents, they want to buy domestic goods, and domestic residents don't want to buy that many foreign goods. This implies that, so there's an excess demand for domestic currency, basically. Suppose that everybody wants to buy Vietnamese mango, but no one in Vietnam wants to buy a German car. Then there would be a current account surplus of Vietnam vis-a-vis Germany, and a huge demand for Vietnamese dong, and a very small demand for euros. Now here you have the net supply of domestic currency from foreign account transactions. So this is the net demand for domestic currency. This is net supply. Well, the net supply of domestic currency comes from the fact that if the financial account is greater than 0, this reflects the domestic purchase of foreign assets are greater than foreign purchase of domestic assets. So domestic residents want to buy foreign assets, so they have to buy the foreign currency, supplying domestic currency to get these foreign assets. The equation that I'm writing down here says that if the exchange rate is flexible, then it just adjusts to satisfy this condition. It's like a supply equals demand equilibrium condition. And the price is the nominal exchange rate. So if the central bank has a fixed exchange rate or targets an exchange rate that deviates from the market equilibrium, it has to influence demand supply conditions for exchange markets. But let's first look at, let's look at the picture, right? This is the nominal exchange rate on the vertical axis. It's the current account and the financial account on the horizontal axis. You have the current account increasing in the nominal exchange rate because if the nominal exchange rate increases, domestic goods get cheaper for foreigners and they buy more of them. This is a disappointingly short summary of the hour that we spent into understanding this relationship. But that's what it boils down to. Conversely, if the nominal exchange rate goes down, this means that it becomes expensive for foreigners to buy domestic assets and cheap for domestic residents to buy foreign assets, and so the financial account is likely to go in this direction. And if we abstract from the capital account, which is a pain in the neck, then the current account should be equal to the financial account, excluding reserves, and you can establish the equilibrium nominal exchange rate. Bingo. There it is. Now, here you are at the following situation, right? You're running a current account deficit. You're running a current account deficit, happily so, and you finance the current account deficit through a net incurrence of foreign liabilities, borrowing abroad, and foreigners are happy to do that, right? To lend you or to buy your assets because, they like to have your assets. And so they allow you to run a current account deficit. Now, what happens in case of a sudden stop? Well, in case of a sudden stop, all of a sudden the appetite of foreign investors for domestic assets decreases. And that implies that this thing, which was negative, may actually move to the right, which sounds like a good thing, but it means that you cannot sell your liabilities that easy anymore. People just don't want to lend you, and you cannot borrow. And we get a similar result to the one that we had before the break, right? And it's reflected by these demand shifters, like the financial account old, right? And this just reflects that domestic assets become less attractive, for example, because of higher perceived risk. So this thing shifts to the right, signaling that you cannot borrow so much on financial markets anymore, and this has immediate implications for the nominal exchange rate, which depreciates. So this is kind of the nominal exchange rate foreign exchange market story of the sudden stop, which is, of course, very much related to the real exchange rate story that I told you just 90 minutes ago. Now let's store that, and now let's look at the fixed exchange rate. Right? So here you got that domestic currency depreciating. Now, with a fixed exchange rate, the central bank has to intervene on foreign exchange markets to bring about equilibrium at a given exchange rate. So the central bank has an exchange rate target. It says we want to target that exchange rate. That's what we want to see. Now, you have excess demand for domestic currency if the sum of the current account and capital account is bigger than the financial account at the given exchange rate. And well, here's the financial account non-reserves. We've moved it to the left-hand side by just subtracting. So in that case, you have excess demand for domestic currency. Now, what do you do if you don't want the exchange rate to adjust because you have an exchange rate target? Well, the central bank has to increase the supply of the domestic currency by buying foreign currency, and you have an increase of reserves. So this positive difference is reflected by delta R being greater than 0. Make a long story short, so let me give you an example. China in the early 2000s. In the early 2000s, China was running huge current account surpluses. Everybody wanted to have Chinese goods. This was positive. Forget about the capital account. Now, what about the financial account non-reserves of China? Well, it was strongly negative. Everybody wanted to buy Chinese assets. So please note, if FANR is negative, it means that your liabilities are increasing faster than your assets. So now everybody wanted to have Chinese yuan, either to buy Chinese goods or to buy Chinese firms. So there was a huge demand for Chinese yuan. Now, that would have resulted in a massive appreciation of the Chinese yuan. The People's Bank of China didn't want to see that, and what they did, they intervened, and they intervened in foreign exchange markets by selling yuan and buying dollars. Now, guess who is one of the biggest creditors of the US government? The People's Bank of China. So that's weird, right? I mean, you have that trade war, and you have, the current president making all these statements about, what he wants to do to the Chinese. At the same time, they are holding a huge amount of government debt because they bought that in the context of their foreign exchange interventions of the early 2000s. Now, I don't know, how do you treat your biggest creditor? It's up to them. Now, here an excess supply of domestic currency. So just to follow up on that, the problem is, of course, would we expect China to sell off that stuff in 2 weeks? No. Why? Well, suppose you're selling off thousands of billions of US dollar treasuries, you will probably make the market collapse, and the first victim will be you, because you're selling something that's worth nothing at low prices. And so it is like the People's Bank of China has to be very careful about that stuff, those US government bonds, right? They cannot sell them off immediately because that would hurt them themselves. Okay, it's an interesting thing. I haven't looked at the balance sheet of the People's Bank of China for a while, but I remember these huge foreign exchange interventions in the early 2000s. Okay, now suppose that the current account balance at the given exchange rate is smaller than the financial account balance. Or put differently, suppose that you're running a current account deficit and people in your country want to buy foreign assets and the foreigners don't want to buy your assets, then this would be positive. So you have a current account deficit and you have a financial account surplus. Now, financial account surplus sounds good because the surplus always sounds good, but a financial account surplus means domestic residents want to take their money out of the domestic currency into the foreign currency, and foreign residents don't want to buy the domestic currency. Then, of course, in a flexible exchange rate environment, what happens is the domestic currency depreciates, right? That's just this situation, right? I mean, suppose that we start here, right? This is the flexible exchange rate. We start here. We're happily running a current account deficit. And the financial markets are happily financing this current account deficit by borrowing, by lending, or by purchasing our assets. And all of a sudden, they don't want to do that anymore. Because maybe the domestic government goes nuts and they don't trust it. All right? Then you have a problem because you're running a current account deficit, but so everybody wants to have foreign currency, but there's no one abroad who wants to have the domestic currency because people are not buying domestic assets anymore. Now, with a flexible exchange rate, this results in a normal depreciation, big time. Now, with a fixed exchange rate, this is not allowed to happen because you want to fix the exchange rate. So what can you do? Well, there has to be something negative, which basically means that you have to sell foreign currency and thus increase the supply of foreign currency on the market, and increase the demand for domestic currency at the same time. So it's like, suppose I'm going to the Ben Cat street market and I have two things: a wallet full of Vietnamese dong and a truck full of mangoes. And suppose I'm walking around and I realize the mango price is too high. What can I do? I can open my truck and say, look, I'm adding supply to the market and I'm pushing down the price. Or suppose I feel like the mango price is too low. Then I would just take the money that I have and buy more mangoes and push up the price. This is exactly how foreign exchange interventions work, right? You either sell foreign currency or you buy foreign currency and you try to influence demand-supply conditions on the foreign exchange market. Now, there's a catch, however. If you increase foreign reserves, you're selling your own money to buy foreign reserves. That's something that you can always do because you are the central bank. So you create your own money, everybody wants to have it, so be it, right? Now, in the second case, this is tricky because if you want to sell foreign reserves, you have to have them in the first place. It's like, if I want to sell mangoes, I have to have them. And so, if the central bank has very little foreign exchange reserves, the stock of reserves may deplete very quickly. And that's exactly what happened during the Asian financial crisis. The Central Bank of Thailand tried to go against this imminent depreciation of the Thai baht, and they sold their reserves, and within a couple of days, these reserves were gone. And then, what did they have to do? Abandon the peg and let the Thai baht float. So, let me put this into a picture. Suppose you have a sudden stop with an exchange rate target. So you're running a current account deficit happily, right? And the exchange rate, the current account deficit was financed by foreigners buying your assets, lending you. Now the mood of foreign investors changes, and they don't want to buy these assets anymore. Now, with a flexible exchange rate, the exchange rate moves up, a nominal depreciation. With a fixed exchange rate, you don't want to have that. What you do instead is you intervene in foreign exchange markets. You have delta R t plus 1 smaller than 0, and you essentially go back to this point. Not because financial markets do that, but because you do it. Financial markets want to see the currency depreciate. You don't want to see that, so you go against it by selling foreign exchange reserves. So that's exactly what's happening, right? So what's the difference? The difference is in the old situation, this came about as a market equilibrium, right? You had for these financial account shifters. Now you have these new financial account shifters, and you establish the only way of defending the peg is that you try to, you're putting reserves, you're selling your reserves. Now, you can do that for a while, but at some point your reserves will be depleted. Let me check. This is a beautiful example. Actually, it's not at all beautiful, but it's illustrating an important point. Now, what happened in Turkey in the year 2020? First, look at the current account. How do you interpret the evolution of the current account in Turkey in between 2019 and 2020? Yep, the current account went down big time. What do you think is responsible for that? Well, there's several things being responsible for it, but I want to highlight this drop. Now, what happened in Turkey, or Turkey as they would want to have it called quite recently. What happened in this country in 2020? What happened in the world in 2020? COVID. Now, what does Turkey sell? A lot of stuff, but also, I mean, kebab, okay. But there's something else that a lot of Europeans enjoy in Turkey. It's the seaside. Turkey is big seller of tourism services. Actually, this is one of the reasons why Turkey is so friendly in Russia. They need the Russian tourists. That's a fact. Now, in 2020, the Russian invasion of Ukraine was not yet, I mean, we couldn't imagine it at that time, but tourism revenues dropped substantially. I mean, you also have something in the goods part, but you have that drop in tourism, which was an immediate effect of the COVID pandemic. Now, so you have a change in the current account, a move in the current account. Now you see that when you look at the financial account, you see that, I mean, there's net earned emissions, there's the capital account, forget it. You see the financial account turned heavily negative. Now, what was it in the financial account that really turned the financial account negative? Now, yep. It's the reserves. So the Turkish Central Bank sold reserves like you wouldn't believe. What does that indicate? It indicates that the Central Bank of Turkey wanted to prevent an excessive depreciation. Now here we're not talking about a sudden stop. We're talking about a sudden current account shift caused by the pandemic. How do we illustrate that? Well, let me give you the picture. Let's hope that I'm not going to mess things up. Right. So this is Turkey in 2020. Actually, I can use this one. That's Turkey's balance payments in 2020. So you have the nominal exchange rate, and you have the current account balance, say 2019, and you have the financial account balance in 2019, and you have that nominal exchange rate, right? And all of a sudden you have this shift in the current account balance, and it's exogenous, right? It's sorry, it's not a big thing, but I'm using subscripts usually for time, so let me do that here as well. Sorry about okay, so the logic is very simple. The logic is, well, if people cannot travel to Turkey, they cannot spend money in Turkey. If they cannot spend money in Turkey, they don't need Turkish lira. If they don't need Turkish lira, and we're talking about millions and millions of people, then they don't buy Turkish lira, and so the demand for Turkish lira goes down, and so the nominal exchange rate goes up. However, apparently, and this is the interesting part, the Turkish Central Bank said we don't want to see that, right? We don't want to see a massive depreciation. And this is indicated by what we saw on the previous slide. So what the Turkish Central Bank did is, that's FA NR 2020 plus delta R. So the Turkish central